Hi, my name is Hector Del Castillo, and I'm Chief Marketing Officer of Byond, and I want to welcome all of you to today's webcast. The topic for today is 5 steps to successfully sell your business. And today's guest speaker is Lori Wiggins, CEO of Byond. Lori, how are you?
Good, Hector, and how are you?
Doing great. And it's a pleasure to see you today, and it's a very exciting topic. I'm actually eager to find out more about it. Before we get started, let's go do some housekeeping items. First of all, special thanks to Scott Taylor and Antonio Bray for being the people behind the scenes, handling all the audiovisual equipment for today's webcast. And we are going to be sharing a link to each one of you where you can actually view the slides, also listen to the podcast, as well as watch the video that will be produced after today's live session. If you're on Twitter, use hashtag exit strategy and also handles at BeyondMA, as well as Lori's handle at Lori J. Wiggins. And feel free to share any information that we're going to be discussing today on Twitter with your followers. A little bit more about Byond. We provide actionable intelligence to business executives and owners to help them achieve outcomes beyond expectations. So Lori, tell me a little more about why we're doing this topic. Why is it so exciting for prospective owners that are looking to sell their company?
Studies show that most M&A deals fail within the first 3 years, or to put it a little more positively, 20 to 25% of sellers and buyers are successful in their M&A. We want to change that, and we're going to talk about how to do that.
Great. Looking forward to it.
Let's go through the steps briefly that it takes to sell your business successfully. The first step is to be deal ready. Step 2 is set your objectives. 3 is plan your sale. 4 is find your buyers. And lastly, close the deal, step 5.
5 steps, 1 through 5, sounds easy enough, right?
If only. Let's look at this more closely. Let's talk about what it means to be deal ready. Traditional M&A, you sell your company as is. The process takes 9 months to a year, and there's 2 steps to the process. You prep your transaction by getting your team together, getting your documents together, and finding your buyers. And then you go through the transaction, which can take several months. However, if you want to maximize your profit, you need to maximize the value of your business. This is part of what it means to be deal ready. Getting deal ready takes 6 to 24 months. So let's look in more detail at what that really means. Why do you become deal ready? Well, you can maximize the price that you can get for your company by up to 71%. That's a hefty amount. In order to become deal ready, you need to do 2 main things. One of them is think about what you want out of your sale, your objectives and your goals. This will influence how you sell your company and who you will sell it to. Part 2 is doing a company analysis, doing a gap analysis specifically. When you assess your goals and objectives, what are your thoughts and feelings about selling your company? Having conversations with your family and your colleagues is important to gauge where you're at. Look at your station in life and your life situation, as well as market conditions. All these things influence your decisions in this area. As far as a company gap analysis goes, what you're doing is identifying underperforming areas of your company so that you can unlock the value, the wealth that you can achieve in those areas. Byond does these sorts of analyses, and we look at all areas of a company or critical areas of a company depending on client desires. We look at things like competition, your operational and back-end processes. We look at customer service, how you're doing your marketing and sales, cybersecurity, more about that in a moment, your culture, your reputation, your management, your technology. Why do we look at these things? Business owners who want to buy your company are looking for ways to devalue their initial offer. They look at things like, how scalable is your company? In other words, is your profit margin increasing faster than your revenues? Or put another way, are your profits increasing faster than your costs? Are you over-dependent on one customer? If more than 15% of your yearly revenue is due to one customer, you're over-dependent and you need more customers. How unique is your value proposition in your marketplace? And what is your customer satisfaction and retention like? Step 2, set objectives. You think that'd be simple, wouldn't you?
Yes. It's not my business, so why don't I just decide what I want to do with it?
Exactly. Let's look at that more closely. First, you want to determine your company value. There's a number of ways of doing this, and there are also professionals that do this for a living, but it's expensive. A good way of understanding your company value is to look at companies similar to yours that have sold within the last year, or if you need more analogs, to go back further than that. In any case, looking at your company valuation means including market and industry conditions as well as economic and regulatory factors, not all of which are under your control. Next, you want to secure an experienced team. M&A is a complicated business. It also is a months-long transaction, sometimes years. You need help because going through M&A is like having another half-time to full-time job. It also requires a diverse set of skills. For example, a business advisor such as ourselves who's familiar with all aspects of your company. Next, you may want to consult your banker or financier as far as financial terms of the deal. Lawyers and accountants are required to address the legal and financial aspects of a deal. And finally, a wealth manager. Organizing and facilitating these experts during the deal requires help. The last thing that you want to do is to have your company drop in value because you didn't have time to run it because you were going through the M&A process. Why do you need financial planning? In order to reduce your tax liability after sale, you need to do some planning before sale. Specifically, you want to reduce your capital gains as much as possible. Also, you want to understand if you're giving this money to others, you need to get them ready for the money and you need to get the money ready for them. What are your financial goals? What do you want out of the deal from a financial point of view? And what do you want to do with it? Do you want to go to Vegas, blow it on a Maserati, or retire? Let's look at planning your sale and the steps required there. There are two types of buyers you'll encounter. The first one is the strategic buyer. They want to buy and hold your company for the long term. They're interested in your products, your IP, your customers. They want to absorb you into their company so that they can increase their bottom line. Versus financial buyers who are interested first and foremost in your cash flow. They'll see ways that they can improve it. They'll hold your company for 3 to 7 years and then flip it for profit. Another question for you to consider is, once the company's sold, do you want to stay with the company or are you done? Also, timing of the sale. It's difficult to time the markets. Usually, personal circumstances or market circumstances drive your need or desire for selling. Structuring your transaction. There are 3 major ways you do this. Buyers buy your company in a couple of different ways. The first is a stock sale, where the buyer comes in, buys all your stock, and now you are fully owned by them, although you are a going entity. In the asset seller transaction, Company A buys a piece of Company B, but not the entire company. In a merger, Company A subsumes Company B, and Company B no longer exists as an entity. Let's look at some examples. Disney's impending purchase of 21st Century Fox will mean that Fox is owned completely by Disney, although it is still a going entity. Only $52 billion. Next is the asset sale example. Spectrum sold in 2017 its battery and lighting division to Energizer. Energizer's adding to its battery empire, but Spectrum as a company is still separate and viable. Apple's purchase of Beat Electronics in 2014 is a good example of a merger. Apple wanted to get into the subscription streaming music business, and Beat was a good acquisition, but Beat no longer exists as a separate entity. Speaking of structuring your transaction, there's a couple of ways to go. First is the negotiated sale, where you're dealing with one buyer only, versus an auction where you're dealing with either a controlled number of buyers in the targeted auction, say 5 to 15 buyers, or a full and open auction. There's pros and cons to each. With the negotiated sale, you're much more likely to keep the deal under wraps until it's all said and done. And if that's the most important thing to you, then of course that's a very important consideration. With the auction, you're much more likely to get a higher price. So there are things to think about there. How to be a good seller. It's important to have your data and information organized and ready at hand. You want to have one company focal so your buyer knows exactly who to go to for questions and to get more information. It's important that you have a professional demeanor at all times. Why are you doing all this? It's to show the buyer that you are serious about the sale. Also, when it comes to negotiating with the buyer, in those situations where it's not always clear, you can buy yourself the benefit of the doubt, and that can make the difference between success and failure in your negotiations. A good example of what not to do is as follows. We know of a situation where Company A wanted to go buy Company B, and when contacted, Company B was amenable to the discussion. Company A wanted to see the financials of Company B, and so Company B produced the yellow pad upon which all of the company's financials were being tracked. Well, it's safe to say that that deal died very quickly. When you are identifying potential buyers, it can be your competition, it can be your suppliers, it can be your customers, or those companies that are in adjacent markets. It's important to have multiple buyers so that you can maximize your price. Also, if possible, you want to pre-qualify your buyers, and there's a number of ways to do that. But what you want to do is avoid the tire kickers. You don't want to waste your precious time on people who are not absolutely serious about purchasing your company. Finally, you have your pitch book. This is really your offering document. Produced professionally so that it looks good as well as telling the truth. It previews your company to buyers. It includes your company history, your markets, your growth potential, your team, your IP, and your high-level financials. Also, you need to establish a data room. In the past, these were physical places with stacks of documents that buyers could go to find out more about your company, things that they will need and want to know. These days, they are electronic. They're online, where you post your documents so that buyers can take a closer look at you. It's important that they be complete, that they present your company in the most positive light, yet are truthful. Have your documentation in order. It's critical. Next, let's talk about finding a buyer. Finding a buyer. Mm-hmm. Buyers who are more serious about talking with you will ask you to sign a confidentiality agreement. CAs are much like NDAs or non-disclosure agreements, except they include clauses about not talking to other people or other companies about the deal. Frankly, the fewer people that know about it, the more likely you are to be able to keep it under wraps. Respond promptly when a buyer sends a CA. Letter of intent. Will you marry me? Receiving a letter of intent is a good sign. It shows that your first round of negotiations was successful. The LOI memorializes the fundamentals of the deal in writing. It includes things like price and terms, taking care of key personnel to keep them on board, expenses incurred during M&A and who pays for them, as well as other closing clauses. Although you're not at the altar, this is an important step towards getting there. As you continue negotiations, the acquisition agreement will be drafted. During this point, during this process, you will want to respond promptly to all buyer requests and questions. That handy data room, if you set it up correctly, will take care of most of this, but your focal will also be kept busy potentially during this time. The buyer will perform due diligence. Count on it. There's a couple of levels of due diligence. The first one is what we call the paper check. This is the legal and financial check. Are these things in order? And the buyer goes no further, but don't count on it. Most buyers are smarter than that, and they will do the deeper dive. They will look at everything from your customers and probably want to interview them. They'll want to interview various people within your company, key people. They will want to understand your marketing, your financials, all of your contracts, especially your customer contracts. They'll take a look at your HR and operational and back-end processes. They will want to do a very thorough look. Not only do they not want to buy any hidden liabilities, because that's part of what they're looking for, but they're also looking to see if they can reduce their initial offer to you. Here's where your deal readiness really pays off. You've already looked at all these things and fixed the problems. So they're a lot less likely to find chinks in your armor, and you're likely to get all of that initial offer that they provided to you. Lastly, close the deal. What does this mean? So that final offer that's being negotiated, it's going to include many things, but highlighting a few here are your price and considerations. So what are the terms of the deal? How and when do you get paid? We could have a whole talk just on that. A word about representations and warranties. The finances that you've provided the buyer, the customer contracts, and other information you've provided. Here is where you must warrant that you have told the truth about those items. Just so you know, that's coming. If you want to make sure that key employees are retained and you want to pay them bonuses or make other considerations, those have to be included in this contract, as well as any closing conditions. Let's say that your buyer is insisting that you extend your key customer contracts 2 more years, where those have to be re-upped and signed before closing. And finally, termination clauses. If either buyer or seller do not fulfill all of the obligations required by the contract, there can be stiff penalties. Lastly, integration considerations. The buyer will need to integrate your people, your systems, and your data with their company to one level or another. Understand that you will be required to assist them in this process because the buyer will spend significant time, money, and personnel to do so. Let's review what we've learned. Here are the steps in summary. Assess your business situation in step 1, as well as business strategy and understanding your business gaps, identifying them. In step 2, you're going to determine your valuation, secure an experienced team, perform financial planning, and fill those business gaps you identified in step 1. In step 3, planning your sale, you want to plan your approach and structure your transaction. Make sure you are a good seller. Identify potential buyers and establish your data room. For step 4, finding buyers, you're going to receive a confidentiality agreement and review that LOI carefully. Draft an acquisition agreement and understand that you will be subjected to due diligence. For step 5, closing the deal, negotiate and participate in integration. Understand that we've touched upon many subjects during this brief talk, but there's much more information and detail associated with each of these steps and sub-steps.
Great. Well, thank you for that overview. And audience, we're going to be going into Q&A next. But before we do that, I'd like to actually remind you to submit your questions using the questions box, and we'll get to your questions as time allows during the Q&A portion. I also want to talk a little bit more about upcoming events, and this particular event, the Brutally Honest M&A Stories You Need to Know, is a panel discussion. We've invited a few business owners who have gone through some sort of merger or acquisition in the last few years, and they will be sharing their stories. And they will be sharing things that they learned, things that they should know now they should have known then, and they will be actually talking about what they're doing next in their lives. And it's a great venue for you to meet other business owners as well as meet the actual panelists, and then talk to experts that we will be bringing that can help you in any merger or transaction deal.
If you're going to be in Tysons, Virginia on May 9th, be sure to join us.
Yes, and you be sure to use the URL at the bottom of this slide to sign up and register for this particular event. Again, this is an exclusive event for business executives and owners. And also, our next webcast continues next month, and we will be continuing same time, same channel. And the topic for next month's webcast is growing your business through mergers and acquisitions. That will be held Wednesday, May 23rd, 1 to 2 p.m. And the URL at the bottom of the slide is the sign-up page where you can register to attend. And we look forward to seeing you same time, same channel next month. And now we're ready for Q&A. And Lori, in the Q&A process, one of the things you mentioned in step 1 specifically, and being deal ready, what is the list of things that you went through there was actually quite extensive. Can you maybe summarize a little more why it takes that long to become deal ready? What does step 1 take so long?
Sure. If you've done the gap analysis with your company, typically there are multiple areas that require attention. Mm-hmm. So depending on the amount of resources, and it's not just money, it's people's time too that it takes to address these areas. Mm-hmm. Depending on the amount of resources and the number of areas that require attention, that's why you see a big time bar there. So some people get it done very rapidly. They address these areas rapidly, and others, they need more time.
So it really depends on how fast and how quickly the entire company is moving towards accomplishing some of the action items that they need to accomplish in step 1. Is that right?
That's right.
Great. And you also mentioned due diligence. And can you explain a little more about what happens there, and typically what is the ratio of deals that don't go through because of issues discovered during due diligence?
Buyers who know what they're doing will want to look not only at your data room documentation, but they will request additional documentation. They'll want to interview key employees as well as your management team, and they'll want to talk to your customers. Again, they're looking for hidden problems. They may also have cybersecurity experts come in and examine your cybersecurity solutions to make sure that you're covered, or to find holes where maybe some of your critical and confidential data has been leaking.
Great. Now, you also mentioned that there's kind of like a two-step process in due diligence, and it sounded to me like the most critical thing is to make sure your papers are in order, because there's the first pass is a paper check. Is that correct?
That's right. But it doesn't just stop with having your documentation in order. That's necessary, but not sufficient. You really need to have a good understanding of all of your processes and having them documented. You need to understand where you have holes so you can fix them before your buyer finds them. That's the bottom line.
And can you explain to the audience like how typically when we get involved in either step one or beyond, how do we work with our clients?
Right. So we do what the client wants, but ideally, if we can help you become deal ready, then you can fetch the maximum price and therefore walk away with the maximum amount of money in your pocket. We can also help you facilitate and organize all of the people on your M&A team, because you don't need your lawyer or your accountant or your wealth advisor for the entire time, but you do need their full attention at critical points in the process. So organizing and orchestrating all that takes time and energy. When you need that help, we can provide that help. And we know how to work with these professionals so that you only pay for their time when you need it.
Great. You also mentioned that as opposed to going to one expert, M&A deals in the process itself requires a team of experts. Can you explain to the audience how we actually help them in making sure that they have the access to the right team of experts in the process throughout the steps?
Sure. So for being deal ready, typically it's the business advisors, us. If specific expertise for a given company area is needed, we work with the whole team of them, but often it's not. Sometimes it's just some fundamental tenets that need to be addressed. So you don't pay for expertise that you don't necessarily need. As we move into the transaction phase of M&A, again, it's utilizing the team of professionals when you need them and also making sure that they're doing the job that they need to be doing. These professionals, in addition to their very specific technical expertise, whether that's legal, whether that's financial, or whatever, sometimes they can be the source of buyers. Sometimes they have other contacts which can be utilized. And so we can help draw from them as much as possible to help them help you the best.
Great. Thank you very much. And Lori, I really want to thank you for a great discussion. I thought it was a really interesting topic, and we hope to see you at one of our future webcasts. Any last words for the audience?
Thanks, Hector. I just want to say thanks for joining us today. It's been our pleasure, and we look forward to seeing you at a future event.
Great. Thank you very much. And once again, if you're interested in setting up a free consultation with us, be sure to use the information on this slide. You can either contact us via email or through our website. Set up a time where we can discuss your specific business situation and let us show you how we can help you. We hope to see you again, same time, same channel, next month for our next webcast. Thank you very much. Have a great week.